Hey everyone, so today we're going to calculate volatility or standard deviation on stock returns. So just like in our last video, we're pulling our data from Quando and we are working with a data frame called pivoted like so. And we're just continuing with our last video on variance. So what is standard deviation? Well, you'll notice here standard deviation is very similar to variance. The only difference is we're taking the square root of variance. And you may ask, why are we taking the square root of variance? Well, the interesting thing about standard deviation is that it is expressed in the same units as measurement as the observed values. And what do I mean by that? Well, if we look at these observed values, these were daily stock returns. Well, the interesting thing about standard deviation is that we can interpret it as a daily stock return. It's a percentage. If these were prices, we'd be able to interpret standard deviation as prices in dollars or cents. In variance, we couldn't have done that. So let's see if we can actually calculate this out in Python. So all we need to do is we're going to take our NumPy library, np, and we're going to say np.square root and take the square root of the variance of Apple, which we calculated in our last video. And there we go. We have the daily standard deviation. And it's important to note that as a daily standard deviation. Usually in finance, what we like to do is we like to annualize our standard deviations. So to do that, we're going to call this annual SD. And that is just going to be equal to, and I'll say this is daily SD is equal like so. And I'll put this for everybody. And then annual SD is just equal to the daily standard deviation multiplied by the square root of 250. So let's say np.square root of 250. And again, you may ask, why are we multiplying it by the square root of 250? Well, we usually assume that there are about 250 trading days in the year. So we'll put this like so. And there we go. We have our annualized standard deviation of Apple stock returns. So of course, if we wanted to calculate this on all of these tickers in our data frame, we can quite easily do that. So all we need to do is we're just going to take our original data frame, pivoted. And remember, these are daily prices. We need to apply a percent change function on top of them. So now we have daily returns. And again, we want to get the natural log of these daily returns. So we're going to say dot apply lambda x, and we're going to say np.log 1 plus x. And there we go. We have the natural log of these stock returns. And finally, if we want to just calculate standard deviation, there's a built-in function. We can say like so, and there we go. We have the daily standard deviation. But if we want to annualize this, we can again use the dot apply function, and we're going to say lambda x. So for each value in this new data series here, we're going to say x times the square root of 250. So for each value x in here, we're going to multiply it by the square root of 250. And there's our annualized standard deviation of all our stock tickers. Finally, if we just want to plot this, we can say dot plot kind equals bar. And that should run. And there we go. There's our annualized standard deviations. If you like this video, please subscribe. In our next videos, we're going to talk about covariance and correlation, all very important in building out an optimal portfolio and understanding total portfolio variance.